fresh chapter in U.S. fiscal politics. Short-term relief, but our long-term challenges inevitable. Summary. Rising Treasury yields hint at fiscal unease. The tax bill could cut tax revenues by $4.5 trillion over a decade. Boosted corporate profits and stock market growth anticipated. New York, July 3rd. In a move that temporarily sidesteps a looming U.S. government default, President Donald Trump's reset tax cut and spending bill deepens the nation's long-term debt issues. U.S. House Republicans passed a comprehensive bill that continues Trump's 2017 tax cuts, allocates additional funds for border security and military, implements significant cuts to Medicare and Medicaid, and will inevitably expand the federal debt. Trump is expected to endorse the legislation. Amid the proposed tax plan, Congress addressed the U.S. government's soaring $36.1 trillion borrowing ceiling by raising it by $5 trillion, a decision that mitigates the immediate risk of a U.S. debt default. Although this decision restrains the Treasury's potential default, analysts warn that it might spell trouble for the nation's fiscal stability over time. Nonpartisan assessments suggest the bill will inflate the national debt by approximately $3.4 trillion in the forthcoming decade. This increase in debt could worsen worries about the abundance of bonds and the reduced interest among investors for U.S. Treasuries, assets that have been fundamental to financial markets recently. Here's where it gets attention-grabbing. Experts like Mike Medeiros, a macro strategist at Wellington Management, argue that the bill escalates concerns related to two crucial issues: the persistent fiscal deficit and soaring debt levels, along with the rising inflation concerns. And this is the part where opinions diverge. Discounters like BlackRock have raised warnings, stating that foreign interest in U.S. debt is dwindling, and there's a significant chance that the demand for the $500 billion debt issued by the U.S. every week may decline, driving up borrowing expenses. BlackRock's investment managers have publicly stated, "Our outlook on the U.S. government's debt levels puts the issue at the center of the greatest risk to America's esteemed position in global financial markets." Could this truly reshape economic dynamics? The legislation is estimated to slash tax revenues by an incredible $4.5 trillion, while cutting spending by $1.2 trillion and potentially eliminating federal health insurance for 10.9 million individuals within a decade. While these measures strive to stimulate the economy by enabling businesses to fully write off equipment purchases and R&D costs, and providing other tax incentives, some investors are anxious that the enduring debt could further limit the economic stimulus intended by the One Big Beautiful Bill. As Campy Goodman, a fixed income portfolio manager at Wellington Management, noted, he anticipates the bill's contributions to growth at around 0.5% next year. However, he worries that markets are underestimating the prolonged risk of elevated borrowing costs. But here's where it becomes contentious. Ellen Hazen from F. Putnam Investment Management pointed out that while the One Big Beautiful Bill could propel corporate earnings and consequently equity values, it also raises the likelihood of sustained higher Treasury rates, which could diminish the appeal of many fixed income investments over time. As we move forward, the financial market reacted calmly to the bill's approval. Investors had factored in the spending expansion already, with attention shifting towards growth prospects. In your view, is this tax legislation a clever economic strategy or a potential misstep for America's long-term financial health? Share your thoughts in the comments.